Economies grow. Debt grows faster. Why does debt keep growing even when economies grow? It sounds logical that if a country's economy expands, its debt should shrink relative to income. But modern economic systems are built on credit expansion. Growth and debt are not opposites. They are partners. In many cases, growth actually requires more borrowing. 10 reasons debt keeps growing even during economic growth. 1. Modern growth is credit-driven. Businesses expand using loans. Consumers buy homes, cars, and goods using credit. Governments fund infrastructure through borrowing. Growth is often fueled by borrowed money, so expansion automatically increases debt levels. 2. Governments rarely run surpluses. Even in strong economic periods, governments tend to spend more than they collect in taxes. Political incentives favor spending on development, defense, and welfare rather than aggressively paying down debt. 3. Low interest rates encourage borrowing. When rates are low, borrowing becomes cheap. Governments and corporations take advantage of easy credit to finance expansion, acquisitions, and projects, increasing total debt even while GDP rises. 4. Debt is rolled over, not eliminated. Most sovereign debt is refinanced when it matures. Governments issue new bonds to repay old ones. The principal rarely disappears. It just shifts forward in time. 5. Economic growth raises borrowing capacity. As GDP grows, lenders feel more confident. Countries and corporations can borrow more because their income base is larger. Higher growth increases creditworthiness, which enables larger debt issuance. 6. Structural obligations expand over time. Pension systems, health care commitments, and long-term social programs grow with population and demographics. These obligations often require additional borrowing, even during expansion. 7. Financial markets demand safe assets. Government bonds are considered safe investments. Pension funds, banks, and global investors demand them. To meet this demand, governments continue issuing debt. 8. Inflation masks real debt burden. As economies grow nominally, debt appears manageable relative to GDP. This reduces pressure to reduce borrowing, encouraging continued expansion of balance sheets. 9. Private sector debt also expands. It's not just governments. Corporate and household debt rise during economic booms as optimism increases. Asset prices climb, collateral values rise, and borrowing accelerates. 10. Growth targets often depend on stimulus. When growth slows, governments stimulate through borrowing. Over decades, this pattern creates a ratchet effect where debt rises during downturns but rarely falls meaningfully during expansions. Final truth. Debt does not grow despite economic expansion. It grows because the system uses debt to produce expansion. Modern economies are not debt-free engines. They are debt-powered machines.